So, what if the way we've been thinking about the future is, well, just plain wrong? Back in 1965, an economist named Peter Diamond put out a paper that, and I'm not exaggerating here, completely reshaped our understanding of national debt. It's now a cornerstone of modern economics, and it tackles one of the biggest, most persistent questions out there. You know the one. This has been a huge debate for, well, forever. Is the national debt just money we owe to ourselves, a simple transfer from one pocket to another? Or is it a real, heavy burden that we're strapping to the backs of our kids and our grandkids? Turns out, it took a brand new way of looking at the problem to finally get a clear answer.
To get to that answer, Diamond knew he had to completely rebuild how economists thought about time itself. He basically tossed out the old, abstract models and built something that looks a whole lot more like the real world. Less like a single family and more like a relay race.
Okay, so think about it like this. Before Diamond, a lot of the big models saw the economy as this single immortal family, a kind of timeless being making decisions for all eternity. But Diamond came along and said, hold on, that's not how it works at all. He saw the economy for what it is, a continuous relay race, where each generation runs its leg before passing the baton to the next one.
And this is what we call the overlapping generations model, or OLG for short. Now, the basic idea of generations wasn't totally new, but Diamond added a game-changing ingredient: physical capital. We're talking factories, machines, roads, the actual stuff that makes an economy productive. And that one addition, believe me, made all the difference.
At the heart of the model is a life cycle we can all totally relate to. You live for 2 periods. In the first one, you're young, you work, you earn money, and you save some for the future. And in the second period, you're retired, and you live off those savings you worked so hard to build up. Simple, right? But it's powerful, and it's a lot closer to how life actually works.
So how does this simple, personal life cycle connect to the massive, sprawling economy? Well, this is where Diamond's genius really kicks in. He was the one who brilliantly linked our personal decisions about saving and spending directly to the economy's big engine of production, its stock of physical capital.
And here is the key connection. When the younger generation saves money, it doesn't just, sit in a mattress. In Diamond's world, those savings are what actually go out and buy the nation's capital stock. All the factories, all the machines, all the infrastructure that produces everything we use. So individual saving literally fuels national production.
But once he connected these 2 powerful ideas, the relay race of generations and the engine of capital, Diamond stumbled on something completely unexpected. A real paradox that pretty much turned conventional economic wisdom on its head.
This led to a really surprising question. We're always told that savings is a good thing, right? It's a virtue that fuels growth and investment. But what if a perfectly healthy, competitive, free market economy could actually save too much for its own good? Diamond's model showed that, incredibly, the answer is yes.
He called this bizarre situation dynamic inefficiency. It happens when an economy has built up so much capital that the return you get on it, the interest rate, is actually lower than the rate of population growth. Now let that sink in for a second. The economy is saving so much that you could literally just destroy some of its capital, and everyone from today's generation to every generation that follows would actually be better off. It's a truly wild, counterintuitive idea.
Okay, so with this powerful new model in his hands, a model with real people, real capital, and this weird possibility of inefficiency, Diamond could finally go after that big, nagging question about national debt. And his answer hinged on a single powerful idea, something called the displacement effect. It really all boils down to a choice for savers. When you save money, you can put it into productive capital, invest in a new factory, something that will make real goods and services. Or you can buy a government bond, which, at the end of the day, is really just a piece of paper. It's a promise from the government to pay you back later.
Diamond's absolute key insight was that people treat government bonds just like any other kind of wealth. So when the government issues more debt, people don't suddenly start saving more money to buy it. No. Instead, they just swap out physical capital for government bonds in their savings portfolio. They buy the piece of paper instead of investing in the factory. That's the displacement effect in action.
And here's exactly how that burden unfolds step by step. The government issues debt. Savers see these bonds as wealth, so they buy them up, which displaces productive capital. This means the nation's total stock of factories and machines actually shrinks. With less capital to work with, labor is less productive, so wages fall. The end result? Future generations inherit a smaller, less productive economy. And that is the true burden of debt.
But remember that weird paradox of having too much capital? Well, here's the crazy twist in the story. In that very specific, dynamically inefficient case, government debt can actually be a good thing. It basically soaks up all those excess, unproductive savings, and it can nudge that oversaturated economy back towards a healthier balance. It's a subtle, but really fascinating wrinkle in the whole thing.
So what's the lasting impact of this incredible paper? I mean, it's not just about getting an answer to one question about debt. It's about creating a revolutionary new tool that completely changed how economies see the world and its future.
When you boil it down, this one single paper gave us 3 huge contributions. First, it created the definitive workhorse model of overlapping generations with capital. Second, it uncovered that strange but very real possibility of dynamic inefficiency. And third, it gave us a crystal clear way to understand how national debt burdens future generations. It's really a foundational tool of modern economics.
And look, this isn't just some dusty piece of economic history. This model is absolutely central to policy debates that are happening right now today. When economists want to figure out the long-term effects of Social Security, or pension reform, or the real consequences of rising national debt, the very first tool they grab from their toolkit is the Diamond OLG model. Its logic is just baked into how we think about the future. And so, more than half a century later, Diamond's paper leaves us with a really critical question for our own time. As government debts climb all over the world, how much productive capital, how many factories, how much innovation, how much new infrastructure are we displacing right now? And what kind of economy are we really leaving for the generations to come?